Are you trying to figure out how to make your money grow? Warren Buffett, the most successful investor in the world, has strategies that can help beginner investors like you start building wealth today. In this video, we'll break down 10 exclusive Buffett techniques designed specifically to help new investors accelerate their results in 2025 and work toward becoming millionaires. Make sure to hit the like button to support our work, and let's dive straight into the content. The market is on fire, but what does it mean for you? Did you know that last year, 2024, was an incredible year for the stock market? It's like the financial world threw a big party. Stocks in the US and Europe were on the rise, and the S&P 500, the big boss of stock indexes, has grown by an eye-popping 2,800% over the past 40 years. But here's the thing, just because the market is doing well doesn't mean it's the best time to jump in. In the next topic, you're gonna see the big secret from Buffett. When things are too shiny, watch out for overpriced deals. The S&P 500, one of the biggest stock markets, is showing signs of being too shiny, or in adult terms, overvalued. Buffett's advice? Be patient. Don't grab something just because it's there. Wait for a better deal when prices make more sense. It's like waiting for that candy sale after Halloween. Better treats, better prices. Speaking of waiting, why is Buffett sitting on piles of cash instead of buying stocks? Let's take a look at Buffett's secret stash. Why Buffett's sitting on a mountain of cash. Right now, he's keeping a lot of his money in cash and short-term bonds, like super safe piggy banks that pay you a little extra. Why? Because he doesn't see good stocks at the right price yet. Instead of spending on something overpriced, he's being patient and ready to pounce when a great deal comes along. Think of Buffett like a lion in the jungle, calmly waiting for the perfect moment to strike. When the time is right, he'll go big. But how does he know what's worth his time and money? Let's talk about Buffett's superpower. Focusing only on what he really understands. Focus on what you know, Buffett's circle of competence. Warren Buffett believes that you don't need to know everything to be a great investor. You just need to be really good at understanding a few things. He calls this your circle of competence. For example, if you know a lot about how lemonade stands work, you can make smart decisions about lemonade businesses. But if someone asks you to invest in a high-tech robot company and you don't understand it, it's better to pass. Buffett says you should only invest in things you truly understand because it's easier to make wise decisions and avoid big mistakes. Here's the key. It's okay to say, I don't know. Buffett himself avoids investing in companies like Tesla because they're outside his comfort zone, but he's super confident about businesses like Coca-Cola and Bank of America. The lesson is, don't try to understand everything. Instead, focus on what you're good at and don't feel bad about skipping opportunities that don't make sense to you. The next topic is very important. You will learn something that few beginner investors know. Avoiding FOMO and market hype. One of Buffett's strongest principles is to avoid getting swept up in the hype of the market. He warns against the fear of missing out, FOMO, which happens when people see others making quick money and feel pressured to jump in. This often leads to bad decisions, like buying stocks at inflated prices. Buffett reminds investors that just because everyone else is doing it doesn't mean it's a good idea. The best opportunities come when you can think clearly and not get influenced by the crowd. Buffett often points to past market bubbles, like the dot-com boom of the late 1990s. During that time, internet stocks soared, but many had little to no real value behind them. While others chased the hype, Buffett stayed disciplined and avoided investing in overpriced tech companies. When the bubble burst, many lost their money, but Buffett's strategy kept him safe and ready for better opportunities. The next topic is essential for you as a beginner investor to learn from Buffett how to deal with crises and recessions. And to ensure you don't miss Buffett's best investment tips for beginners, subscribe to the channel now. Making the most of market crises. Buffett believes that market crises aren't disasters, they're opportunities. When stock prices fall during a crisis, He sees it as a chance to buy great companies at discounted prices. His strategy during downturns, such as the 2008 financial crisis, has been to use his cash reserves to invest heavily in strong businesses that were temporarily undervalued. For example, during the 1987 market crash, Buffett invested in Coca-Cola when its price dropped, securing a profitable position that grew significantly over time. The key, according to Buffett, is to stay calm and avoid emotional decisions when the market is in chaos. Many beginner investors panic and sell their investments when prices fall, but Buffett advises the opposite. If the fundamentals of the company are still solid, it's a great time to buy. His philosophy is simple: be fearful when others are greedy, and greedy when others are fearful. This mindset has allowed him to capitalize on market volatility and turn temporary downturns into long-term gains. This next topic is fantastic. Let's explore how Buffett prepares for recessions. Preparing for recessions. Buffett's perspective. Recessions are a natural part of the economic cycle, and Buffett emphasizes the importance of being prepared for them rather than trying to predict their exact timing. On average, recessions occur every 6 years, and while no one can know exactly when the next one will hit, Buffett's strategy is to stay ready with a significant cash reserve. This allows him to take advantage of opportunities when asset prices drop, buying high-quality companies at discounted prices. He views recessions as moments to act decisively rather than to panic. Buffett also stresses the importance of having a long-term perspective during economic downturns. While recessions may cause temporary declines in stock prices, they often create conditions for strong recoveries. For example, after the sharp economic challenges of the early 1980s, the S&P 500 experienced significant growth in the years that followed. The Buffett's advice for beginners investors is clear. Don't try to time the market, but ensure that you're financially and mentally prepared to withstand economic turbulence and capitalize on opportunities when they arise. Next, you will learn something fundamental to accelerate your results. And speaking of results, I've put together some exclusive, tried and tested material that's already helping many beginner investors achieve their goals. The link is pinned in the comments. Navigating geopolitical risks. Warren Buffett acknowledges that geopolitical risks, such as conflicts and tensions between nations, can significantly impact markets. However, he advises against making drastic investment decisions based solely on these uncertainties. Instead, Buffett recommends focusing on the long-term resilience of the market. Historically, markets have weathered wars, political crises, and other global challenges, often emerging stronger in the long run. For example, during World War II, the stock market began to recover years before the end of the war, proving its ability to anticipate and adapt to future outcomes. Buffett also emphasizes the importance of owning assets that can hold their value in times of crisis. He suggests investing in tangible assets, such as farmland, real estate, or shares of strong companies, rather than holding large amounts of cash, which tend to lose value during inflation or war. His reasoning is simple. While cash may lose purchasing power in times of uncertainty, productive assets tend to increase in value. In the next section, you'll learn a highly valuable secret: Buffett's golden rules for choosing investments. One of Buffett's most enduring lessons is that quality matters more than quantity when it comes to investing. He emphasizes that you don't need to own hundreds of stocks to be successful. Instead, focus on a small number of high-quality companies. These are companies with solid fundamentals, competitive advantage, and reliable earnings. Buffett often says that making just 4 or 5 major investment decisions in a lifetime is enough to build substantial wealth. The key is to be selective and wait for opportunities where the odds of success are in your favor. Another critical rule is to buy undervalued assets and hold them for the long term. He looks for companies with a solid track record and the potential to grow, even in volatile markets. You need to know what's in the next section urgently. Buffett's take on market timing. Buffett is notoriously skeptical about market timing. He believes that trying to predict when the market will rise or fall is a losing game for most investors. Instead, he emphasizes staying invested in the market and focusing on long-term goals. Buffett points out that the stock market usually recovers well before the economy, as seen in previous recessions. I strongly recommend this video to you so that you don't make the mistakes that could take you out of the game.